If your strategy only works when you're right, it was never an edge to begin with. Most traders believe the secret is finding the perfect setup, the right indicator, the cleanest entry, the strategy that finally stops losing. They spend months, sometimes years, tweaking rules, switching systems, and jumping markets, convinced that somewhere out there is a method that just works. And when it doesn't, they assume the strategy failed. Here's the uncomfortable truth. A completely random entry, something as simple as a coin toss, can make money in the markets if the rules around it are followed. And most traders hate that idea. Not because it's wrong, but because it attacks the one thing they're emotionally attached to: the need to be right. 95% of traders are searching for better strategies. The other 5 are barely searching at all. They're executing. Same markets, same volatility, same opportunities. One group keeps changing what they trade. The other keeps doing the same thing long enough for probability to matter. The 95% believe trading success comes from prediction. If they can just forecast price better, everything else will fall into place. When trades fail, they blame the strategy. They abandon it before it ever has a chance to work. They move on, convinced the edge wasn't real. The 5% understand something that feels almost offensive at first. Most strategies already work well enough. The problem isn't the system. It's the trader breaking it, skipping trades, taking trades that don't qualify, changing risk after losses, interfering when emotions show up. The edge dies, not because the strategy is bad, but because the rules are optional. In this video, we're going to break one of the most deeply held beliefs in trading: why strategies don't fail the way you think they do, how randomness exposes what really makes money over time, and why following simple rules consistently matters more than how clever your setup looks. Part 2. What happens when you actually let probability play out? Most traders don't want to hear this, but they already have something that could work. Not perfectly, not flawlessly, but well enough. The problem is they never give it the chance to prove itself. Take the trader who's always refining his strategy. He backtests endlessly, adjusts rules after every losing streak. If the last 5 trades didn't work, something must be wrong. Maybe the entry is late. Maybe the stop is too tight. Maybe the market conditions have changed. He tweaks, restarts, and resets the stats. Over and over. On paper, it looks like progress. In reality, he's constantly resetting the clock. He tells himself he's being logical, disciplined even, but what he's really doing is avoiding uncertainty. He never sits through enough trades to let probability show up. The moment the strategy feels uncomfortable, he abandons it. Losses become proof the system is broken instead of a normal part of distribution. He's not trading a strategy. He's trading his emotions around it. Now, look at another trader. Same market, same time frame. His rules are almost embarrassingly simple. Fixed risk, fixed target. No filters that change week to week. He doesn't care if the last trade won or lost. If the rules say take it, he takes it. If they don't, he waits. There's no interpretation once the session starts. Here's where the coin toss idea comes in. Imagine both traders were given the same experiment. Entries decided by a coin flip. Heads, buy, tails, sell. Nothing clever, no prediction, just randomness. But with strict rules. Same position size every time, same stop, same target, and a large enough sample of trades. The first trader wouldn't last a week. After a few losses, he'd start skipping trades. After a couple of wins, he'd get confident and increase size. After boredom sets in, he'd interfere. The randomness wouldn't be the problem. His behavior would be. The second trader would do something most people find incredibly difficult. He'd keep going. Trade after trade, win or lose. He wouldn't try to be right. He'd try to be consistent. Over time, the results would start to make sense. Not because the entries were good, but because the execution was stable. This is what most traders miss. They think strategies fail because the logic isn't strong enough. In reality, most strategies fail because the trader can't behave randomly when outcomes are random. They interfere. They optimize midstream. They stop following the rules as soon as the distribution doesn't look the way they hoped. A coin toss doesn't care about your last trade. It doesn't get confident after a win or scared after a loss. Traders do, and that difference is everything. Until rules are followed without negotiation, even the best-looking strategy will collapse under the weight of human behavior. Part 3. Why randomness feels wrong but works anyway. So why does this idea create so much resistance? Why does the suggestion that a coin toss can work feel almost insulting to most traders? Because it attacks the real attachment, not to money, but to identity. Most traders don't just want to make money. They want to be right. They want confirmation that their analysis, their intelligence, their screen time means something. A strategy that works because of probability, not prediction, takes that validation away. It says the market doesn't care how clever you are. And that's uncomfortable. This is the first psychological block. Traders confuse being right with being profitable. Being right feels good immediately. Profitability only shows up over time. So when a strategy produces a string of losses, even if those losses are expected, the ego feels threatened. The mind starts looking for reasons. Something must be wrong. The rules must need adjusting. The strategy must be flawed. Anything is easier than accepting that losing streaks are part of the game. The second issue is short-term sample bias. Traders judge strategies far too quickly. 5 trades, 10 trades, maybe 20. If the results don't look good, they pull the plug. But probability doesn't reveal itself in tiny samples. Randomness clusters. Losses come in streaks. Wins do too. A coin toss can land heads 5 times in a row and still be perfectly fair. Traders understand this conceptually, but emotionally, they expect smooth results. When they don't get them, doubt takes over. Then, there's the discomfort with randomness itself. Humans are wired to look for patterns, even where none exist. In trading, this leads to overfitting, adding filters, adding conditions, adjusting rules to explain recent outcomes. The coin toss theory exposes how much of this is just an attempt to regain control. Randomness feels irresponsible. Predictive logic feels professional. So traders lean toward complexity, even when it hurts performance. Another major problem is emotional interference. Random outcomes demand consistent behavior, but traders aren't consistent. After losses, fear creeps in. Trades get skipped. After wins, confidence spikes. Risk increases. After boredom, rules loosen. None of this is part of the strategy, but all of it impacts results. The edge disappears not because the system stopped working, but because behavior changed mid-sample. This leads to a deeper truth. Most traders don't actually want a system that works. They want a system that feels good to trade. They want excitement when it wins and reassurance when it loses. But probability doesn't care about feelings. It only responds to repetition and consistency. The traders who make it accept something most never do. Outcomes are random in the short term. Control comes from behavior, not prediction. They stop trying to force meaning into every trade and start focusing on one thing only. Did I follow the rules? When that becomes the only question that matters, strategies stop feeling fragile, and the need to constantly change them fades away. Part 4. When following rules becomes the only edge that matters. This is where everything flips. The focus moves away from finding the right strategy and lands where it should have been all along, on execution. The question stops being, does this strategy work, and becomes, can I follow this without interference for long enough? The coin toss theory isn't saying entries don't matter at all. It's showing you what actually matters more. Rules, fixed risk, fixed exits, consistent sizing, a sample size large enough for probability to show up. When those things are in place, even randomness can produce structure. Without them, even the smartest strategy falls apart. What makes a strategy profitable isn't how clever it looks on a chart. It's how repeatable it is in real conditions. Can you take the next trade after a loss without hesitation? Can you take it after a win without getting greedy? Can you follow the rules when you're bored, tired, or frustrated? Most traders can't, and that's why their strategies feel like they stop working. At some point, the identity has to change. You stop seeing yourself as someone searching for the perfect system and start seeing yourself as someone who executes a process. Your confidence no longer comes from being right about the market. It comes from knowing you'll behave the same way regardless of what the last trade did. Wins don't excite you. Losses don't shake you. They're just data points in a much bigger sample. And this leads to the boring truth. Profitable trading isn't about brilliance, it's about repetition. It's taking the same action hundreds of times without trying to improve it every week. It's letting probability do its job while you stay out of the way. Most people quit here because it feels dull and unrewarding in the moment. But boredom is often the sign that you're finally aligned with how trading actually works. So the choice is simple. You can keep changing strategies, blaming entries, and searching for something better. Or you can commit to one approach, follow the rules without negotiation, and let time and consistency do the heavy lifting. The coin toss theory doesn't remove skill from trading. It exposes where skill really lives, in discipline, patience, and execution. If this perspective makes sense to you, keep following the channel, as we'll be sharing more insights, trading stories, and trading motivation tips in future videos.